Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting.
Good morning, or for those of you who sit in Europe as I do, good afternoon. My name is Terence Wilhelm. I'm an attorney at law and I will be your host for the next 60 minutes. Welcome to this webinar, commonly organized by Pride Partners International and our law firm called CARA. In this webinar, I will address the impacts of the current COVID-19 pandemic on transfer pricing policies. When I think of it, it is the very first time I have to address a topic that is so contemporaneous and so unpredictable. I will therefore do my best to share with you some returns of experience, ideas, and recommendations. I will limit my presentation to a 50-minute time frame in order to spare some time for questions and comments. You will find my contact details at the very end of the presentation, so please do not hesitate to reach out to me afterwards if you want to pursue the discussion. But let's dig immediately into it. Okay, folks, just a bit of introduction first. Economists and analysts around the world are aligned in saying that the economic crisis that will follow the lockdown imposed by the pandemic will be worse than the financial crisis of 2008. As we slowly recover from the lockdown and reopen boundaries, we still need to manage the consequences of the current year and anticipate those applicable on the medium and long run. In this framework, it must be noted that the main bulk of economic operations are performed by multinational enterprises that share among them capitalistic bonds. In other words, economy is predominantly operated by groups of companies. Big ones, small ones, it doesn't matter. They all fall within the transfer pricing arena as they share intercompany transactions. Transfer pricing is a very broad arena and covers all kinds of transactions. Tangible flows, of course, services, financial transactions, operations involving the use of or transfer of intangible property, but not only. This only is the tip of the iceberg. There are other operations that fall within the ambit of transfer pricing, which are business restructurings, the fair allocation of functions and risks, which will command a fair remuneration for such allocation, permanent establishment issues, which also calls for a fair remuneration, the use and attribution of state aids and subsidies, etc., etc. The mismanagement of these items may trigger severe consequences upon the taxpayer. We need to treat the impact of the current crisis on the allocation of profit, which forms the base subject to tax. The tax rates, and of course, the tax to be paid, the financial capacities of these taxpayers to pay those taxes. All this in an environment highly unpredictable and an always harsher pressure from the tax authorities. In this environment, we need to take actions. We sure do not have any crystal ball, at least I don't, but we can anticipate those actions that must be taken in the transfer pricing arena and that at least will show tax authorities that positive actions were taken and decent solutions were to be found. That is why the key words here are anticipation and action. In this webinar, I will endeavor to share with you returns of experience that I've been confronted with, share with you my expertise, and give you some tips and recommendations to cope the best you can with the current crisis. Yet, one thing is certain, no one's got all keys and solutions to the current situation. It is us, tax practitioners, that will certainly contribute the most to the best way to handle these aspects. The consequences on transfer pricing will take various forms, but eventually can be sorted out into three main categories, all of which being correlated and fiercely bound with the two others. Physical consequences first, in the meaning that the lockdown has forced people and workers to eventually operate their activities in different jurisdictions. This will, of course, raise the question of the existence of potential permanent establishments. But when we refer to physical consequences, also mean the way the operational flows are eventually rerouted. Say, for instance, a product that's eventually sourced from a different location, a service that is provided by a different entity, and so on. The second chapter will be dedicated to financial consequences. These are those we immediately think of. How to attribute and share the potential losses derived from this crisis. Can certain entities be immune from making losses? If not, how can we integrate these losses in a comparability analysis, which forms the cornerstone of all transfer pricing regulations? Can we adjust the comparable data we might have access to? Shall we adjust the figures achieved by the taxpayer instead? At last, we will also address the use and the way to manage at best the subsidies and or state aids and plug these with a fair transfer pricing policy. The final chapter will be dedicated to relational consequences. This will lead us to ask ourselves how to integrate those solutions in the way taxpayers interact with tax authorities and with themselves. There are stringent compliance and documentation requirements in place in most countries. The question then arises as to how to integrate the current situation in these requirements. But first, let's get physical, if I may speak this way. Let's discuss the consequences of the crisis on the relocation of people and flows. The COVID-19 outbreak has led many countries to implement border controls as a temporary measure to curb infections, and many employers find their employees working from home or in locations outside the jurisdictions where employers typically operate or are located. Those unexpected remote employment and business activities may trigger a local tax presence for which the employer has not planned. This may in turn give rise to increased permanent establishment, and in some circumstances, a change in corporate tax residency. This is what we will address in the coming slides. Of course, if the remote working location of the employee is in the same jurisdiction as his or her employer, such arrangement should not trigger an international tax implication. However, where the employee's home base or location of temporary presence or quarantine is in a different country, the employee's business activities might trigger permanent establishment assertion and potential corporate income tax in the other country of the profit attributable to such permanent establishment. Permanent establishment issues may also arise within certain countries. I had experiences where Canada's provinces generally impose income tax on corporations with a permanent establishment in the state province. So, folks, a primary action is to determine how local requirements and legislation applicable in your environment address permanent establishment issues. According to the latest comments of the OECD, a permanent establishment is any fixed place of business through which the business of an enterprise is wholly or partly carried on. To be characterized as a permanent establishment, the place of business needs a certain degree of permanency, i.e., it is not of a purely temporary nature. I can tell from experience that a home office of an employee may qualify as a permanent establishment in some jurisdictions if the use thereof is not intermittent or incidental, and provided the foreign enterprise requests the employee to use the home office. Generally, the OECD considers 6 months to be a requisite time period, unless the nature of the business requires less time. The typical example here is the duration of the Olympic Games, which lasts for a few weeks only, but during which a permanent establishment may be constituted. As of now, expectations are that the COVID-19 crisis will be resolved in less than 6 months. Hopefully, personnel should be able to return to their usual operations prior to the lapse of this period. Folks, believe me, I do not want to be a scarecrow or be over-pessimistic. Yet, companies may want to consider adopting guidelines for employees working remotely to minimize permanent establishment risk in the future in preparation for a second outbreak or another crisis that creates similar safety conditions. I have been speaking to a Polish speaker lately, and she told me that they expect a second wave of infection to hit Poland in the coming weeks or months. In addition, many countries are considering legislative measures to clarify that the forced home office of an employee does not create a permanent establishment. I have heard that the Australian Taxation Office, the ATO, has set up a COVID-19 frequently asked questions webpage, which addresses, amongst others, the issue of whether the presence of employees in Australia may create a permanent establishment in Australia. I know also that France and Luxembourg have made similar announcements applicable to situations where employees usually travel cross-border to their work from neighboring countries. Still, there are certain treaties which contain other permanent establishment deeming rules that could be triggered by a remote workforce. For example, the Canada and US tax treaty may deem an enterprise of one state to have a permanent establishment in the other state if the enterprise performs services, for example, through employees in the other states for an aggregate of 183 days. If you ask me, I frankly doubt tax authorities will be perverted enough to claim a permanent establishment exists if those measures are performed on a very limited period of time. Yet, I can only advise you to maintain contemporaneous documentation and any supportive material showing that, first, the organization with people scattered everywhere is temporary by nature, and second, that a thorough validation process is in place within the company. This leads us to the dependent agent issue. Indeed, employees contracting outside of the home jurisdiction may also constitute a dependent agent PE. Yet, even though the permanent establishment definition has been revisited in the multilateral instrument, the individual still has to exercise the authority repeatedly to create a permanent establishment. Occasional and one-off actions should not rise to the level of creating a remote contracting agent. So, okay, even if the OECD commentary of 2017 does not mention a specific period of time to create such a PE, the commentaries make reference to the general guidance issued for fixed places of businesses. Therefore, the above mentioned 6-month period should be considered. So again, if the restrictions caused by COVID-19 are lifted prior to the lapse of the 6-month period, I believe the risk of a dependent agent PE might be limited. Dependent agent PE is one thing, but the COVID-19 outbreak may also result in multinational enterprises having to change the location of their board meetings given substantial travel restrictions. In this respect, most double tax treaties include a clause which provides that a company being a resident of 2 contracting states is deemed to be a resident only of the state in which its place of effective management is situated. The term place of effective management refers to the top-level management, which is where executives and senior staff make the day-to-day management decisions. In ordinary times, companies would make sure that the board of directors making critical management decisions would meet in one place. However, what can be done if people are not allowed to travel anymore? What if board members are located in countries that are not the country of incorporation? Though not addressed by the OECD, countries commonly agree that where board meetings are conducted over telephone in a conference call or through video conferences with people being physically present in different countries, there is not one single place of effective management until a certain number of people in one location has the ultimately decisive vote. Where the voting rights are located such as 2 directors have the decisive vote and both directors are residents in the same country, which is not the country of incorporation, tax authorities of such country may assert that the place of effective management is effectively located there. In this case, companies might want to temporarily change the voting rights, providing for directors resident in the country of incorporation being part of the decisive vote. Where the company does not have a director resident in the country of incorporation, care must be taken that the decisive votes are not concentrated in any one country. Where the bylaws provide for such allocation of the voting rights, a temporary alteration should be implemented, thereby ensuring that directors who are all residents in different countries take the decisive vote. If all of the above is not possible, and the company cannot avoid having the effective place of management in a different country for the duration of the crisis, the company is well advised to keep the decision-making process to a minimum, if and where possible, of course, and return to previous profits as soon as possible. It goes without saying that companies should also put in place documentary evidence showing that the new decision-making process is only allowed and in place for the duration of the crisis as an extraordinary measure and only because of existing travel limitations and safety concerns. Such documentation should clearly state that the process will be reversed as soon as restrictions are lifted. I'm telling you, contemporaneous board meeting minutes will serve as useful documentation to explain why such actions were taken. Moving to the next section, business restructuring. Some companies are shutting down or scaling back their operations in various jurisdictions, both voluntarily and involuntarily. In countries where the restructuring leads to decrease of taxable bases, for example, a fully fledged distributor becoming a limited risk distributor or an agent, the restructuring may entail exit charges. It is therefore crucial to determine if the regulation applicable commands a remuneration to be granted for any drop of revenue, the transfer of a qualified intangible or intangible assets, and if such operation finds a fair counterpart which may not be monetary. Aside of this, some companies could seek to restructure their supply chains to prevent single sourcing and ensure business continuity in case of disruptions. These business restructurings may therefore be necessary to improve supply chains and, I'm quoting, preserve profitability or limit losses. In all these cases, the question is, which entity or entities within the group should bear the costs of the restructuring and how the intercompany pricing should be reset? In this regard, Chapter 9 of the Transfer Pricing Guidelines provides some helpful guidance on the termination or substantial renegotiation of intercompany arrangements in the context of business restructurings. These restructurings could involve temporary shutdowns of operations, measures to stem losses in situations of overcapacity or economic downturn, realignment of supply chain to introduce multiple sources, etc. Think about it. If a loss-making entity is shut down, the restructured entity is actually being saved from the likelihood of a loss-making opportunity. For example, it may make sense for manufacturing capacity to move from one entity to another because the first entity may no longer be able to operate, even if this is not her fault. No compensation likely would be due to the first entity, since it is not being relieved of a profit-making opportunity, but rather of an expectation of significant losses. Similarly, if the tested party to a transactional net margin method transaction has shut down, it may make sense for that tested party to not receive a routine return for the duration of the shutdown period and only receive the cost of reimbursement. The cost base on which this reimbursement is calculated may also need to be carefully considered if many of the one-time expenses benefit future periods, for instance, such as preparing equipment to be restarted. Further, there may be situations where a company needs to set up new or additional activities in a jurisdiction to make up for the lack of production elsewhere in its supply chain. This business decision may be temporary or may result in a long-term change to the supply chain to diversify and limit single sourcing risk. In such situations, the loss-making or shut down entity can be maintained, but the entities within the group benefiting from its continued existence would need to bear the cost of maintaining it. This is it, folks, for what pertains to the first chapter dedicated to physical consequences. The tip of the iceberg when it comes to the consequences, much more are the financial consequences, which are addressed in the next sections. How to attribute losses. For many multinational enterprises, the COVID-19 business environment will entail a sharp increase in costs, as well as a potential decline in demand, which may drive down system profits, resulting in extraordinary losses impacting the company's financial results. As a result, it should be considered how to account for such unplanned fluctuating operating results from a transfer pricing perspective. In this respect, critical transfer pricing assessments are necessary to determine whether losses and gains associated with COVID-19 should be allocated between the value chain participants. Consideration may include, but are not limited to, an assessment of the management and allocation of risks. What does the company's transfer pricing documentation or legal agreement say about which parties bear specific risk, force majeure clauses, etc.? Where is special event risk borne according to the company's transfer pricing model? Where are key risk management decisions responses being made? Consideration should also be given as to whether a loss split model might be appropriate in the current economic climate. However, while a loss split model might be an option in some fact patterns, head offices looking to pass along some of those losses should be cautious if those associated parties have been categorized as routine or low-risk entities under previous transfer pricing analysis, as this will be difficult to support without substantive changes in the subsidiaries' functional profiles. Should routine service providers bear some of the group's losses? Most tax administrations tend to consider that entities engaging in routine functions and correlatively bearing routine risks should be kept immune from making losses. But my friends, here is the simple truth. No entity can be kept immune from making losses. It simply doesn't make any sense. It doesn't exist. No matter the maturity of the market on which we operate, any economic player may at some point derive operating losses. So to know or support the idea that a routine entity may derive losses, a range of questions need to be considered. Did the associated party record increased profits during profitable years? Are such losses consistent with the function, asset, and risk profile of the associated party? Is there a justified commercial reason that allows the associated party to record a reduced level of profits as opposed to previous years? Should associated parties renegotiate their arrangements, or the third parties may be doing it in the current environment? If a local entity has been set up as a low-risk entity and has been compensated using corresponding transfer pricing method, like a cost plus, for example, it might be difficult to justify losses in that local entity. A similar issue occurs where the high-risk functions are located. In most normal circumstances, that jurisdiction would be expected to bear the gains and losses associated with an economic crisis. It is worth noting that countries' views diverge in this respect. For example, the Chinese tax authorities specifically issued guidance after the 2008 financial crisis that single-function low-risk entities would not bear the risks related to the financial crisis and were not allowed to make losses. Therefore, it is advisable to survey the positions of local jurisdictions before reporting losses, or gains, of course, locally. A variety of additional issues are likely to arise, especially as extraordinary expenses, such as potential layoffs, termination payments, lease breakage fees, and asset impairment occur. Consideration will have to be given as to who should bear these costs based on the functional and risk profiles. If you ask me, even in normal circumstances, any operator may make losses no matter the functional characterization given. For your information, in France, there are several court decisions where the judge considered that making operating losses is in itself not sufficient to consider that the transfer pricing policy applied did not reflect arm's length standards. That is quite logical indeed. Transfer pricing will of course influence the profitability of the company, but other external features may also contribute to such loss-making state. It is therefore crucial to determine if the losses are extraordinary in nature, i.e. they are linked to the pandemic, and if these losses are attributable to the entity at stake, considering its capacity to monitor and have control over the risks. Still, it is one thing to admit that any business operator may make losses. There is a corollary to this, as we then need to evaluate the magnitude of these losses to attribute. This, therefore, naturally leads us to independent and comparable references, and more specifically, the amount of profit margin they might also derive. So, how to reflect this in the economic analysis? As you know, reflecting what independent players would do in a comparable situation forms the cornerstone of any transfer pricing analysis. It is the essence of the arm's length principle. Normally, in the context of a transfer pricing economic analysis, for example, through a transactional net margin method, a common method for testing an intercompany transaction in 2020 would be looking at the average of the 3 previous years, assuming that the economic circumstances in the year under analysis are similar. However, in 2020 and most likely in the following years, the economics of many companies will be negatively impacted by COVID-19, while the previous 3 years' financials are not affected. Publicly available data for comparison is not available in real time, so there will also be a time lag, i.e. 2 years usually in testing and supporting positions taken. To align the comparability analysis with the changing economic conditions, companies may adopt the following strategies. Inclusion of loss-making companies in the comparable set. Well, from me to you, I don't see any reason for not including these in the first place, notwithstanding the period in the review, as these loss-making companies do reflect a specific state of the market. And again, no business operator is kept immune from making losses. Another idea would be to choose a different analysis time period than the conventional 3 years. Eventually, one may think of selecting comparables on a year that was hit by a rather similar crisis, for example, 2008. This at least could highlight the comparables' behaviors on a year subject to strong financial distress. On the opposite side, one may think of applying a longer testing period to smooth out the non-transfer pricing related results. Another alternative could be to apply specific adjustments to the financial data for comparison in order to consider the actual economic crisis. Instead of the median, aim at the first quartile. But from me to you, this is a bit weak for a gesture. Multinational enterprises may isolate the impact of the COVID-19 crisis and hence isolate the loss by adjusting the tested party and comparable companies' results based on the SG&A to sales ratio experienced during unaffected years. Indeed, during an economic downturn, companies typically experience an increase in SG&A as a percentage of sales, given that they cannot rapidly adjust their fixed costs to offset lower sales. Check also for the possibilities offered by certain tax jurisdictions. US Treasury provides flexibility for US taxpayers to report transfer prices. Taxpayers may affirmatively use Section 482 to report prices other than those charged on a timely original tax return if necessary to arrive at an arm's length results. Amended or untimely returns may also be used to report corrected arm's length prices, but only if this increases US taxable income. However, from experience, I can tell such adjustments may not be respected in the other countries. How to integrate state aids? Good questions. Well, governments around the world are announcing extreme measures, the likes of which have never been seen before. These are varied and wide-ranging, from income replacement and salary subsidies, interest-free or low-interest loans, guarantees, grants, just to name a few examples. A critical question for taxpayers is how these amounts should be treated for transfer pricing purposes. For example, if an entity receives compensation from a related party on a cost-plus basis, should any government grants or wage subsidies be netted against costs for computing the cost base that is subject to markup? Or should it be kept out of the computation and become additional income for the entity that receives it? Consider the example on the slide. On the second column, the state aids are withdrawn from the cost base because they are considered as a profit return the counterparty should not pay for. The net return of the tested party would then end up at 60 minus 10, being the state aid, plus 40 equals 90. If the tested party is remunerated at cost plus 10%, its return will then be 9. On the opposite, see the third column. If the state aid is considered as out of scope for transfer pricing purposes, they are therefore not taken into consideration for purposes of calculating the cost base. Then the cost base is set at 60 plus 40 and hence 100. The markup set at 10% will then lead to a 10% profit return versus 9 previously, and the tested party in that case may have to pay taxes on 110 rather than on 99. As illustrated in this example, the decision taken by the group can have a material impact on the in-company charges and the resulting profits realized by the tested party. Given the magnitude of the supports being rolled out to mitigate the economic impact of COVID-19, taxpayers should be sure to identify and track any such supports and give due consideration to local transfer pricing rules and laws. As an example, the Canadian Revenue Agency has published administrative guidance suggesting that the amounts should be excluded from transfer pricing computations and the full benefit should remain in Canada, unless the taxpayer can prove that arm's length parties would treat such governance support differently. A slightly different approach took place in France. In the so-called Philips court case, the court considered that unless the French tax administration can demonstrate that independent operators would act differently, the taxpayer should be entitled to deduct the state aids from the cost base subject to cost plus. Okay, folks, this is it for our second chapter. We'll end up with the third and last chapter dedicated to what I called relational consequences, i.e., the impacts on the way stakeholders interact and how this crisis will eventually impact the balance in their relationships. How will this crisis impact the relationship between taxpayers and tax authorities? Well, of course, at this stage, we have no crystal ball. It is hard to predict whether tax authorities will be more flexible and tolerant towards taxpayers as these need to recover from the crisis, or conversely, if, considering most economies have been bleeding out, tax authorities will reinforce tax audits and multiply adjustments. If you ask me, I believe a little bit of both will occur. On the one hand, governments may communicate on the fact that they will freeze tax rates or eventually even reduce them, and in the meantime, put more pressure on taxpayers and increase the fight against tax optimization schemes to ensure the fair amount of tax is being collected. But it's a fact. Even before the crisis, transfer pricing were on the radar of most, not to say all tax authorities. The few statistics one may have access to reveal that transfer pricing matters form a very hot topic, and in the broad sense of it, i.e., combining transfer pricing with permanent establishment issues, withholding tax and other correlative consequences and penalties, etc. It certainly even represents the lion's share of tax reassessments in most Western countries. It is therefore foreseeable that tax audits will multiply in the near future. Those transactions that were already under high scrutiny, such as financial transactions, cash pool, intercompany loans, implicit guarantees, etc., will certainly be placed under the microscope, and notably now that the OECD released its guidelines regarding financial transactions specifically. For sure, this will give some ideas to tax authorities and tax practitioners alike. The same holds true for what pertains to intangible transactions, transactions involving hard-to-value intangibles, the use of IP federal tax regimes, restructurings involving potential transfer of clientele or other characterized IPs will again draw the tax authorities' attention. Even more because now, most tax schemes need to be documented and published, either via the transfer pricing documentation, the country-by-country reporting, CBCR, which, as you know, some countries, notably in Europe, want to be available to public, the so-called MDR, mandatory disclosure rules, etc. So, in this environment, specific care must be given to ensure the transfer pricing documentation is properly prepared. Not only must it be contemporaneous, but specific care will need to be given that the current situation is addressed as part of the functional analysis, notably to support the allocation of risks between all stakeholders. In this regard, if you ask me, there is room for optimism, and one may consider that this situation offers a unique possibility to test the transfer pricing model in live conditions. Indeed, this situation enables to check whether the decision-taking entities are those that are mentioned as such in the documentation reports, or if the entities forming the group do have control of the risks, or conversely, if such allocation was just for the show. Still, transfer pricing documentation must clearly show that low profits or losses were not the result of non-arm's length transfer pricing policies or practices. No, and over the next couple of months, it may be prudent to model the impact of COVID-19 on operating results, to demonstrate and document, of course, the losses are due to external features that are disconnected from transfer pricing, or that the model that may have been implemented to cope with the crisis is fair and adequate to respond to the crisis in such a way to meet the taxpayers' interests. In particular, the following should be considered and supported. Any restrictions on movements of people and products, the impact of COVID-19 on productivity, the drop in services being provided, the impact of COVID-19 on profitability across the multinational group and how this is being allocated, how risk is assigned across the group and any changes made in this area. I also strongly advise the documentations now integrate parts and sections that are not specifically required under the OECD Action 13 and those local requirements that align on this. Are also more specifically advised to integrate market or industry analysis as well as any supportive documents that provide insights on the state of the market on which the taxpayer operates. I suggest integrating these in the local files or eventually the master file as well. This is to highlight the stress the other operators were subject to and which to some extent may explain the losses or the volatility of the profits derived. At last, for those taxpayers that are bound by an advanced pricing agreement, the pandemic could potentially impact current advanced pricing agreements negotiations as the effect of the pandemic on the economy is uncertain and conceivably independent comparables could be in loss-making positions over the next few years. Agreeing appropriately wide critical assumptions will be key to managing the ultimate impact. There is the potential for current APA terms to be breached as a result of the impact of the pandemic. Well, on the other hand, this situation may also be the trigger to initiate an APA. It goes without saying. Uncertain times create great uncertainties, and most taxpayers need legal and tax certainty. To cope with this and avoid any future adjustment, it might therefore be the perfect timing to launch an APA. Well, if you ask me, this is the theoretical part. For those of you who have initiated APAs in the past, you know that such process could turn into a real nightmare. It can be time-consuming and cost-consuming. I personally recall situations with Italy or Japan, for example, where APAs took years to be finalized and eventually we had to renew it immediately to benefit from its modalities. Plus, I doubt most countries will invest in reinforcing the teams in charge of APAs and mutual agreement procedures. Eventually, they might reinforce tax audit teams, but these are disconnected. On the contrary, in turbulent financial times like these, most countries may even cut in their recruitment policies and by the same token, may lay off public servants. Anyway, no matter how this will turn out, I strongly advise you all to maintain thorough and contemporaneous documentation, either formal documentation, but also any kind of record to eventually defend yourselves 2 or 3 years from now when the tax audit will fall. Okay, folks, the last part, as my time is running out, let's finally discuss about how relations between taxpayers will be impacted. How will this crisis impact the relationship between taxpayers? In most instances, the entities forming the group need to follow the policies enacted by the mother company or the operational headquarters. But what if these policies do no longer enable these entities to derive a fair amount of profit? As in any transfer pricing analysis, the actions of unrelated parties in the face of the pandemic, of course, are central to analyzing arm's length behavior for related party transactions. In the context of written contractual arrangements, the starting point is analyzing the written terms of the agreement. If your group is already aware that the COVID-19 crisis will require adjustments of profitability levels or have significant impact on the supply chain, we recommend that the intercompany agreements are amended now, if possible, in respect of the termination and renegotiation clauses, since adjusting profitability levels or other contractual assumptions which contradict existing agreements may cause legal and transfer pricing scrutiny. Amending the intercompany agreements now, when in the middle of the crisis, is recommended as this would be expected between independent parties. Some companies may find that they do not have flexibility to adjust pricing policies to respond to unforeseen circumstances. They may therefore think of terminating the agreement, for instance, by invoking a so-called force majeure clause. Note in this respect that some common force majeure events in the context of COVID-19 could be natural disasters or governmental prohibitions of activities. But consider that in this respect, and for example, French courts have denied the spread of other illnesses as qualifying force majeure events because they were not considered as unforeseeable or unavoidable. It is unclear whether a resulting economic crisis may be such an event. In Luxembourg, for instance, in the context of a financial transaction, the court held that the economic crisis of 2008 could not be considered as a force majeure and could not exempt the debtor of the obligation from reimbursing its loan. Further, companies should view the pandemic holistically within the context of the agreement. For example, if an agreement has a 10-year term and the effect of the pandemic prevents a party from performing for only a few months, is that enough to excuse performance? Would the results be different for an agreement with a 2-year term? Well, the practical answer is that unrelated parties will be in court 1 to 2 years from now with the benefit of hindsight, but today, no one has these answers. Hopefully, in an intercompany arena, things shall be much easier as both parties belong to the same group and therefore pursue common global interests. Aside of the force majeure clause, other companies may realize they have locked themselves into a result that no longer makes economic and/or business sense. Companies in this camp may be able to amend their agreements, but should be prepared to address potential challenges by tax authorities, which may argue that consideration is required for the amendment in some cases. Moreover, if a change in transfer pricing policy is not accompanied by a change in functions, assets, and risks, tax authorities might not respect the change or might challenge prior year's results on the basis of the new policy. Yet, in certain countries, the doctrine of rescission may provide relief for taxpayers who wish to undo rather than modify related party transactions. US Treasury regulations, for example, provide that the rescission will be respected and the original transaction disregarded if the rescission occurs in the same taxable year as the original transaction and the parties are returned to the status they occupied prior to such transaction. Again, Whether a rescission will be respected in a counterparty jurisdiction depends on foreign law, and rescission poses other challenges as well. Personally, I always consider that transfer pricing analysis must necessarily come together with a thorough legal analysis. It is a nonsense to address transfer pricing without having a close look at the agreements in place and the way these may eventually be renegotiated or terminated. This situation sheds even more light on that statement, and as you can see, a tax and legal analysis are closely interconnected. And I'm not saying that because I'm an attorney as opposed to an economic. I'm saying that because it simply makes sense. Well, folks, this leads us to the conclusion. The transfer pricing issues raised by this COVID-19 pandemic are wide-ranging and vary between industries and even between taxpayers. Considering the time when we had, this webinar could only address a few of the most significant concerns, and believe me, I'm really sorry for that. But still, I really hope you enjoyed it and that this webinar gave you some ideas or guidance that will help you through these turbulent times. Personally, I really had a blast. If you want to push the discussion forward, please do not hesitate to drop me an email, as my contact details are listed in the final slides. So thank you everyone for your patience and for joining today. And on behalf of Pride Partners International, our firm, Kara, and myself, Terence Wilhelm, I wish you good luck. And of course, take good care of you all. Thanks again. Bye.